Good afternoon, Mr. and Mrs. Hess, and thank you so much for taking the time to meet with me today. And congratulations on both of your most recent retirements. And John, of course, the sale of your business after 20 years. Mary, my understanding is that you actually retired last year after being a longtime educator. And John, of course, just selling your business. I'm sure there's some mixed emotions, which is pretty normal. But I hope overall you're both feeling excited as you're heading into full-time retirement together. You've both done a fantastic job of accumulating wealth, setting yourself up with a good amount of retirement income that will allow you to accomplish your retirement goals and retire in comfort. Now I'm here to help in continuing to grow those assets, but also to help preserve those assets into your lifetime and into the future of your family's legacy. So in front of you, you'll see a copy of the comprehensive plan that we prepared, some attached documents with some calculations we'll be reviewing throughout today's meeting, and some of the documents outlining my fiduciary responsibilities and disclosures. Yeah, that's going to be right in front of both of you. Each have a copy. All right. And I also wanted to remind you that a mutual contact, Mr. White, local insurance agent, I believe it's someone that you've worked with in the past or someone that you're thinking about working with here in the future, he referred you, and if we decide to move forward working together, I will receive a payment of $1,333 from Mr. White, as he would prefer I refer any insurance needs back to him so he can fulfill those needs, but that would be 100% up to you. And as I advise all of my clients, it is a good idea to get more than one quote for any insurance related needs. Is there any questions before we get started here? Okay, well, let's begin. So today's meeting will be covering 6 main topics within the financial plan, as you see in front of you. The first topic will be your financial health. That's going to be balance sheet and cash flow items. We'll then move on to risk management, essentially insurance contracts, and covering other insurance recommendation and needs. We'll then move on to investment planning. So we'll be analyzing your current situation and some recommendations and adjustments that will maximize performance and meets the needs and expectations given your risk tolerance. We have retirement planning, so some adjustments we can make to grow assets tax-free, some required minimum distribution planning strategies. Then we'll move on to income tax planning, areas where we can reduce your taxable income and review some taxable events involving the sale of the business. We'll also talk a little bit about charitable giving and how that will benefit you as well. We'll move on to estate planning, how we can maximize or minimize, your potential estate tax, review asset titling to avoid probate and other estate planning strategies that should be considered. So when we conclude, there's going to be an action plan. We'll put priorities on certain items and then set a follow-up meeting to start the process of fulfilling those recommendations. Sound good? Okay, well, now let's go ahead and review your goals here. You've provided some goals for us and some priorities that you want to focus on. One of those goals is to reduce estate gift tax liability and ensure all estate planning documents are in order. We're then going to review insurance contracts, discuss the implications of purchasing long-term care policy, reduce personal income taxes, and then based on the risk tolerance, recommend a diversified portfolio that meets your investment needs and expectations. And reviewing the risk tolerance, it looks like that you both have an above average risk tolerance. So that gives us an idea of what type of asset allocation, or simply put, the mix of stocks and bonds we would recommend. When we make recommendations, we'll consider goals, return needs and expectations, time horizon, and of course your risk tolerance. And within our calculations today, we'll be making some economic assumptions, and the risk-free rate would be one of them. So on a treasury bond, we're going to go ahead and make the assumption of it yielding about 1%. And then assuming inflation at about 2.25%. And that's all listed and detailed there on the attached documents. Okay, let's move on. So let's go ahead and review the financial health. So as of 12/31/2021, you have a net worth of $12,884,524, just under 13 million. A net disposable income of about 1.2 million in the current year. So your net disposable income is especially inflated in the current year due to the 25% down payment of the $1 million from the sale of your business. This also includes 10 monthly installment payments totaling about $365,000, and that's received in 2021 per the terms of the 8-year note installment agreement. The down payment and the ongoing installment payments will play a large role in the achievement of your financial goals, and this will be addressed in detail in other sections of your plan. Let's look at a couple other cash flow items. So, John, you had $11,000 of earned income. Also, Social Security benefits brought in around $26,400. Mary, it looks like you brought in $13,200 from Social Security as well. And then we had some investment income of about $235,000. So when we take all this into consideration, we want to look at certain items. One of them is called the current ratio. So it's a financial ratio that measures your ability to meet your short-term liabilities. And a ratio higher than 1 indicates you have more short-term assets to cover liabilities that would be due within a year or sooner. Typically, a ratio of 1.2 to 2 is a good sign of financial health. Your current ratio is much higher. It came in at about 40. And we're aware some of that cash will be used to pay for taxes in April and also to fund some other short-term goals that you have. Even so, you're in a very good position and we do not see any liquidity issues at this time. So of the $850,000 you have in the bank, we would recommend leaving $250,000 in cash. So if any unexpected expenses do occur, you don't have to dip into investments when timing may be bad, or selling investments may create some unwanted realized gains. Having this safety net will also give you peace of mind, and it can be a big factor in being a successful long-term investor. It's something that we really preach here at this firm, is to always manage your cash flow. That way we don't have to sell any investments when maybe the timing is bad. And we should review your cash reserve amount a few times a year to ensure we're maintaining that safety net and plan for any future significant expenses as well. So why did I choose 250? So 250,000 divided by about 30,000, which is your average monthly expenses. It gives you over 8 months of expenses, slightly over. We typically want to see at least 6 months saved, but considering John, it's your first year in retirement and Mary your second, it doesn't hurt to have a bit more saved, and then we can make adjustments along the way. So in front of you on page 3, you will see detailed calculations on how we recommend you should further utilize the remaining $600,000. You're well positioned first off in paying off the mortgage on the vacation home, paying for the new car, and your goal of funding your grandchildren's 529 and covering the upcoming tax bill. For the funding of the 529 savings plans, you can avoid a gift tax by either making a yearly $15,000 contribution for each Beth, Jack, and Eugene, or special gifting IRS rule that allows you to front load a 529 for up to 5 years at one time with no gift tax consequences. So let's run the numbers here. So we're going to start off with the 600,000. We'll go ahead and budget for 225,000 for the 529. So that's 3 of them, and we're going to front load all 3. We'll then go ahead and reduce that amount by 150,000. That's earmarked for taxes, the sale of the business, and some of the installment payments. Of course, the 40,000 for the new car purchase. We're going to go ahead and also reduce that by 10,500 for the credit card bill from the Europe vacation. I'm so jealous. That sounds like a fantastic way to head into retirement. I'm actually planning a Europe trip next year, so if you have any recommendations, I'd love to hear, maybe either after this meeting or sometime on our next meeting. That'd be great. And then the $50,000 for the mortgage on the vacation home. I mean, you have the capacity to pay it off, and no reason to pay 5% on the loan. Is there any other significant expenses that we should know about? Okay, so this leaves you with about $124,000 that we should recommend investing into a diversified tax-sensitive portfolio, which we're going to discuss more in detail during the investment portion of the financial plan. Now, of course, if you just wanted to start the grandchildren with $50,000 each, we would have more to invest, and then you can continue to make yearly contributions of $15,000 per year without incurring a gift tax. So we wanted to lay out first the front loading, if you wanted to do so, because you have the capacity to do so. But if that's not something you want to do, then $15,000 per year, we can go ahead and plan for that as well. A couple other assets here that we'll be focusing a little bit more coming up here on other sections of the financial plan. You have a stock portfolio, jointly owned, $940,000. Mutual fund portfolio at about 2.9. You both have qualified retirement accounts that we'll be talking about as well. John, a little over $1 million. Mary, about $445,000. We have life insurance policies with cash values that we probably won't need to ever cash out. And we'll be talking a little bit more about those death benefits here going forward. And then we have an annuity for about $102,000. Okay, so moving on to your primary residence. Looks like it has a fair market value of $900,000. No mortgage left on the primary home, so that's great. That's fantastic. Your vacation home in Vermont, fair market value, $750,000, and about $49,000 left on that mortgage. 5% fixed rate. Again, we recommend paying that off. So as we shift to risk management and the insurance portion of your financial plan, let's first review the homeowner's insurance policies. I wanted to bring to your attention that the primary home insurance face value is not 80% of fair market value, which we would recommend. Your current coverage face value is $400,000 and should be increased to $620,000. So for example, if you had a $100,000 claim, you would only be covered at about $64,500. So that leaves a shortfall of about $35,500. So we're recommending that you increase that as soon as possible. The good news is that your vacation home insurance face value of $460,000 is sufficient. So no adjustments needed there. And as far as the life insurance, when we typically recommend increases in payable benefits for clients, it's typically clients with a large amount of debt, or even having children that are pre-college years, or maybe had a lack of retirement income or assets. But since neither of those factors come into play, I believe you have adequate amount of life insurance. And with your assets accumulated, insurance payments would be sufficient amount to still reach your financial goals. Mary, cash value $185,000 on your life insurance with a death benefit of $400,000. John, cash value of $955,000, death benefit of $2 million. So I believe those are sufficient, and we don't need to make any changes on that. Long-term care. So we do recommend purchasing a long-term care policy sooner than later. This will ensure both of you are covered when the time comes. We would recommend a comprehensive plan that covers up to 3 years of coverage or $360,000, whichever comes first. When we look at premiums on average for this type of comprehensive policy, John, it would cost you about $5,250 annually. And Mary, you'd be covered at about $4,000 annually. With the monthly savings from not having to pay the vacation mortgage, this will more than cover the cost of the annual long-term care premium. So that's the good news. And I would recommend setting up a meeting with your insurance agent about the recommendations of the increase on the primary homeowner's insurance policy and implementing the long-term care policy as soon as possible. Okay, let's move on to investments. Excuse me. So for investments, taxable accounts, we have two taxable accounts. We have the stock portfolio at $940,000 currently, jointly owned. And then John, you own individually the mutual fund portfolio at about $2.9 million. Two qualified retirement accounts. John, you have a 401k, a little over $1 million. And Mary, you have that 403b at about $545,000. The stock portfolio, unfortunately, has underperformed, even with a beta higher than the overall market. Beta being the measure of volatility or short-term risk. Stock A in the portfolio has lost most of its value, and selling this stock would provide the opportunity to tax loss harvest about $218,000. We would recommend taking the opportunity of that tax loss harvesting and liquidating the entire portfolio so we can then build out a 60-40 portfolio that is well diversified, and we can use a tax sensitive strategy where we utilize about 40% of the portfolio's tax-free municipal bonds. And remember, we will also have $124,000 to add to this account from the excess of the cash after leaving $250 in the bank. So previously we went over the expenses that you have, right? The amount that we wanted you to keep in the bank. We had $124 left over from that, so we would add it to this investment strategy. For the equity of 60%, we recommend using exchange traded funds versus mutual funds in the portfolio, since this will allow us for ease of diversification, more cost efficient and more tax efficient as well. Have you ever heard of exchange traded funds? Are you familiar with ETFs? Okay, a little bit. Okay. Well, if you're a little unfamiliar with ETFs, our firm has a 2 to 3 minute video that is compliance approved that I could send you in an email that explains the benefits of exchange traded funds versus mutual funds so that you have all the information you need before making your decision. Nothing wrong with mutual funds. I just believe in a taxable account. If we're going to rebalance and we have the opportunity to implement a new strategy, I believe that this is the correct vehicles to use in this stock account, which would then be an exchange traded fund 60-40 portfolio. In addition, over time, we will implement a cost averaging strategy, utilize some of the expected installment payments from the sale of the business into this account. Okay, so the mutual fund portfolio. When we look at the mutual fund portfolio, it's actually done quite well and is well diversified, except it has about 25% international exposure, a little top heavy. So we would recommend reducing that to about 15%, rebalancing into small mid-cap index funds and some tax-free municipal bond exposure. This will balance out the portfolio, reduce overall risk, and add some sectors that you're lacking. Now, this will create some long-term capital gains, but in the long run, this will reduce risk and increase diversification. We also recommend reducing corporate bond exposure in the mutual fund portfolio and replacing it with some municipal bonds, again for the tax-free interest. This will allow you to still have bond exposure, but to lower your overall taxable income. There's really no rush on executing these. We can do this as strategic as possible. And we'll go over the details of these investment strategies and specific recommendations on our next meeting. Any questions on any of that? Okay. So let's go ahead and move into our retirement planning section here. So there's a couple things we can do here to help efficiency within retirement. One of them is something called a qualified retirement distribution. So you both did a great job growing your retirement accounts, but now that you are retired, we would first recommend rolling over the 401k and 403bs into IRAs. So we have more flexibility, as IRAs offer some unique retirement options that 401ks and 403bs don't offer. Right, so IRA strategies. For this example, this will allow for required minimum distributions to be used as qualified charitable distributions, which will lower your taxable income versus increasing it, and will also help to lower your taxable estate. So how this works, this allows anyone over 70 and a half to distribute up to $100,000 per year out of an IRA, and will allow you to will allow you to directly donate to qualified charities and distribute the amount that results in a reduction of your taxable income versus adding to your overall taxable income. So for this strategy, the IRS allows up to $100,000 max per year, but that's a lot of money, and we can work together to find an amount that you're comfortable with if you're charitably inclined and choose to explore this option. As far as RMDs, or required minimum distributions, each year we will review your RMDs and the amounts and calculate that probably in late January, so that we can plan properly and ensure to take the distributions out strategically, stress-free, and before the end of the year. Another advantage of rolling over your qualified retirement accounts is the flexibility to do Roth conversions. This will allow you to pay taxes on a converted amount up front, and once converted into the Roth, those assets will grow tax-free and without the requirement of RMDs, or required minimum distributions, which is great. So if you don't need it, you don't need to take it out. Therefore, you're not paying taxes, and then along the way, the assets are going to appreciate tax-free. Once the rollovers are executed, we'll then look to invest those assets in a similar fashion as the taxable account strategies, excluding the municipal bond exposure, since that would not be appropriate in retirement accounts. We recommend consolidating all investment accounts at the same brokerage firm or custodian. This will allow us to manage all 4 accounts in one place for ease of record keeping and overall convenience. John, as we mentioned earlier, you earned $11,000 this year, and this does allow Mary and yourself to make a max combined $11,000 non-deductible IRA contribution. So for example, you can contribute $6K, Mary $5K, for a combined $11,000 as a non-deductible contribution. We can then convert that money to a Roth IRA. We call this a backdoor Roth conversion. Okay, you're familiar. Okay, so I would recommend doing this before you roll the current qualified retirement accounts over, as this strategy works best tax-wise for people that don't currently have IRA accounts. Converting those assets into the Roth account will allow you to grow that money tax-free. Right, exactly. Okay, so typically for many of our clients heading into retirement, we would now discuss systematic distributions from your investments to cover your expenses. Due to the fact your retirement income is sufficient for over the next 6-8 years, this is not a priority at this time unless you feel otherwise. Besides the RMDs, I don't see a need to plan for any distributions, but instead allow that money to compound and grow over time. When we evaluate your overall picture, it is evident that you have adequate assets, retirement income to meet your goals. With the investment plan that we're recommending and some of the risk management additions, we are confident that you'll be able to live in retirement worry-free. And just remember, we're taking inflation, taxes, and all market cycles into consideration. Our investment recommendations will help you combat that inflation, and the recommended cash reserves will ensure short-term market pullbacks or unanticipated expenses. will likely not disrupt your retirement plan. So moving on to the income tax portion, not the most popular for obvious reasons, but one that's important to tackle in coordination with your tax professional. We should coordinate a time where we all can meet in person or over the phone to make sure we are all on the same page as you make this transition to full retirement. And to be clear, I am not a CPA or tax professional, but that does not mean I don't have an understanding on how to guide and educate my clients on pertinent information and what my clients' options are. Now, the fact you have a relatively high income is a great thing, but that also brings along taxes paid on that income. We can lower that tax bill mostly through tax-free investing, as we discussed earlier, with municipal bonds in a taxable account, Roth IRAs, in coordination with charitable contributions, which we have covered in the previous sections and detailed on the attached documents there in front of you. So taxes owed. Now for the sale of your business, John, let's break down the expected tax ramifications. So first, we have the $1 million down payment. Second, we have the 10 months of installment payments already received. Excuse me. The down payment of the $1 million comes to a taxable amount of $731,250 of long-term capital gains. These calculations are detailed in front of you. Assuming a long-term capital gain rate of 15%, we're looking at a tax bill of about $110,000. And we have the 10 months of installment payments that would be taxed at a total of $194,270, taxed at 15%. So let's add another $29,140 of taxes due. So that comes to a total amount of $139,000. And we've already earmarked and budgeted $150 for taxes. It should be sufficient to cover this tax expense. Now, I know that's a lot of information. I think it's important to share these documents with your tax professional. And if we're able to schedule a joint meeting, we can discuss and, of course, make adjustments as needed. So given the high assumed amount of income for the next 7 to 8 years, and even after for future taxable income from the investments, an effective gifting strategy will prove to be very, very beneficial to avoid potential estate taxes. The yearly tax gifting exclusion is $15,000 or $30,000 as a couple from what we call gift splitting. And if we mention, and as we mentioned earlier, your IRAs are rolled over, we can then run some numbers on how QCDs or qualified charitable distributions can benefit you and lower your taxable income as well. So let's go ahead and move on to estate planning. Currently, John, your estate, as is, could be subject to estate taxes, but with effective estate planning, this can be minimized or even avoided altogether. The current estate tax exemption is $11.7 million per person, or $23.4 million combined. There are no limits on qualified charitable donations, and we could accomplish that through a charitable qualified distributions that would actually reduce your taxable income, reduce your taxable estate. You also can reduce your taxable estate without tapping into your lifetime gift exclusion of 11.7 or combined 23.4 by gifting $15,000 a year or $30,000 as a couple to anyone you would like. If you would like a trust that would receive an income tax deduction for charitable giving, we would recommend you create a charitable remainder annuity trust. This will allow for each spouse to receive income for the rest of their life, with the remainder of the asset to be passed to a charity, and that asset will not be included in your taxable estate. So, to be clear, you create a trust, right? You put an asset in there, you can take income from that asset for your life, and then when you all pass, that would go to a charity, and whatever's left over in that trust will not be added into your taxable estate. So let's talk about probate. You're familiar with probate. We don't like probate. We want to avoid probate unless you have a specific reason. And if you do have a specific reason, please let me know. But if you don't, what we want to do is we want to ensure that assets are jointly owned, have beneficiaries, or titled under a trust. In addition, unless there's a specific reason for adding your estate as beneficiaries, we should title those assets in a strategic way to avoid probate. Currently, both retirement accounts has your estates listed as the beneficiaries. So once we roll over those into IRAs, I would recommend adding each other as beneficiaries and then listing contingent beneficiaries as a backup. This will allow for the avoidance of probate, and we'll be able to use the marital deduction, which will avoid tapping into your lifetime gift tax. Personal use assets, including an out-of-state vacation home, cars, the Jenny stamp, should really be titled under a living trust. At the end of the day, most of my clients will title the majority of their assets under a living trust, so the assets are managed, distributed as your trust details, and for avoidance of probate in case of death or incapacitation. Also, if you already have a will, let's get that reviewed and updated if needed. And if you don't have a will, we recommend that you have one created along with the living trust. So I would recommend a meeting with an estate attorney as soon as possible to discuss the living trust and the will. And once that's completed, then we'll have to title those assets, under that said trust. So, to summarize, Mr. and Mrs. Hess, several financial strengths were identified during the financial planning analysis. However, our analysis also indicates that there's going to be 6 areas that need specific attention. These recommendations are aligned with your goals and will help you improve your financial position. So let's go ahead and review the first one. Visit an estate planning attorney as soon as possible to obtain proper estate planning documents, including a living trust, to plan for either spouse's incapacity. And also, if you don't have a will, let's get that done. If you do, let's get that reviewed. So this requires immediate attention. An attorney can assist you with implementing all of these estate planning recommendations made in this plan. Is it possible for you guys to set up an appointment with an attorney this week? Oh, you already have one? Oh,